This episode will be the first book review episode in our channel, and we are going to introduce a book called The Alchemy of Finance, written by George Soros. Most people think the task of financial markets is to discover the true price or equilibrium price if you study economics theory. But the question Soros really asks is this: does the so-called true price actually exist as a pre-given, pre-existent object? In this episode, I want to introduce a book that I consider extremely important, George Soros' The Alchemy of Finance. The most important part of this book is not a particular trade and not a particular market call, but Soros' understanding of the nature of financial markets. Soros writes at the outset, "I developed a unique investment strategy that ran completely against the prevailing view. The accepted view is that the market is always right, that market prices tend to discount the future accurately, even if the exact nature of future development remains unclear. I started from the opposite view. I'm convinced that insofar as market prices express a bias about the future, the market is always wrong. But the distortion works in both directions. Not only are the expectations of market participants biased, their bias also influences the course of events. This may create the illusion that the market accurately anticipates the future. In reality, it is not that the present expectations correspond to future events, but that the future events are shaped by present expectations. The imperfections in participants' understanding are inherent. There is a two-way connection between the imperfect understanding and the actual course of events, and because of the two-way connection, there can be no correspondence between the two. I call this two-way connection reflexivity. This paragraph almost summarizes the entire book. Soros is not merely saying that markets make mistakes or that markets influences reality. Both are a cliche that we already know. He goes further. If participants' expectations enter into the process of events and shape the future, then market prices cannot simply be a passive reflection of a given reality. That is to say, in financial markets, there is no stable one-way correspondence between perception and reality. And this two-way connection between perception and reality is what Soros calls reflexivity. He then goes on. The hypotheses on which investment decisions are based are designed to make money, not to establish a universal generalization. Both activities involves meaningful risk, and success brings a corresponding reward. Though it is not literally a laboratory, its essence is that successful investment is a form of alchemy. Most market participants do not see the market in this light, which means they do not know what hypothesis is being tested. That is also the meaning of the book's title, The Alchemy of Finance. The investment is not about verifying an objective model in a static world. The participants' judgment changes the process in which they participate. And it is from here that Soros launches his most fundamental challenge to traditional economic theory that we learn at school, perhaps at undergraduate level. He says, economic theory is devoted to the study of equilibrium. The concept of equilibrium is very useful because it allows us to focus on the end result without having to consider the process by which it is reached. But at the same time, it is also a deeply misleading concept. If equilibrium can be reached through the process of adjustment, then the equilibrium point must be observable in some form. Yet, this is not what we find in reality. In real life, equilibrium is hardly ever observed. The flexibility and volatility of market prices are well known. What is observed has merely been assumed to be tending toward equilibrium. But why is equilibrium never actually reached? Participants must adapt to market prices, yes, but what they're adapting to may itself be the moving target. In that case, there's no real adaptation at all, and what economics call equilibrium is little more than a fantasy. He then adds, the concept of equilibrium is the product of an axiomatic system. The structure of economic theory resembles logic or mathematics. It is built upon certain postulates, and all conclusions are derived logically from them. The unreality of equilibrium does not undermine the validity of logical structure itself. But serious distortion arises if one takes a hypothetical equilibrium as a model of reality. Soros is not saying that logical reasoning itself is the problem. He's saying that the problem begins when those assumptions are taken as a model of the real world. That is why he goes on to question the premise of perfect knowledge. The assumption of perfect knowledge is doubtful if the object of knowledge includes the participation of thinking subjects. Such knowledge can no longer be called knowledge. Even as students, I found this assumption especially difficult to accept. And also information. Perfect information is contemporary formulation of the same assumption. Unfortunately, this assumption is not sufficient to support the theoretical edifice. To make up for what it lacks, modern economists resort to an ingenious move. They insist that the supply and demand curves should be treated as given. But in Soros' view, once participants' thoughts and actions affect reality, many of the so-called given conditions are no longer given. So he formulates this method as a recursive relationship. When the two functions operate simultaneously, they interfere with each other. A function normally produces a determinate result given an independent variable. But in this case, the independent variable of one function is the dependent variable of the other. Determinate results disappear. What we see is an interaction in which both the situation and the participant's views are dependent variables, so that an initial change can suddenly trigger further changes in both the situation and participant's views. I call this interaction reflexivity. In simple mathematical terms, reflexivity can be expressed as a pair of recursive functions. The cognitive function y equals to fx, and the participating function x equals to phi y. And therefore we have y equals to f phi y and x equals to phi fx. This is the theoretical foundation of my approach. Two recursive functions do not produce an equilibrium outcome. They produce only an endless process of change. Here the cognitive function and participating function are nested inside one another. So what we're dealing with is no longer a system of moving toward equilibrium, but an ever-changing historical process. Next, Soros applies this theory concretely into the stock market. He says that the stock market is precisely the best point of entry for studying reflexivity in the empirical world. Another reason for starting with the stock market is that it offers the best point of entry for the study of reflexivity. Like any market, the stock market seems to satisfy the standards of perfect competition. A central market, homogeneous products, low transaction and transportation costs, easy communications, enough participants to ensure that no one can influence prices in day-to-day trading, rules against insider trading, and special safeguards to make information available to all participants. What better conditions could one ask for? If any place could put the theory of perfect competition into practice, the stock market would be the obvious candidate. The problem is that we do not find any evidence of an equilibrium point or even a movement of prices towards the equilibrium. And it is precisely in the stock market that he states his most important rebuttal. My view is exactly the opposite. I do not believe that stock prices are a passive reflection of underlying value, still less that they tend to correspond to it. I maintain that market values are always distorted. Moreover, and this is a decisive departure from equilibrium theory, this distortion has the power to affect the underlying value. Stock prices are not simply passive reactions. They play an active role in a process that simultaneously determines both stock prices and the fortunes of the companies whose stocks are traded. In other words, I regard changes in stock prices as part of a historical process and a focus on the interplay between participants' expectations and the course of events, and on the causal role that this interplay plays in the process. This is one of the most powerful parts of the book. Price is not merely a passive result. Price itself enters the causal chain. That is why he replaces the superstition that the market is always right with two propositions. I replace the superstition that the market is always right with two propositions. First, the market always shows a bias. Second, the market can influence the events it anticipates. Taken together, these two propositions explain why the market so often appears to anticipate future events correctly. He then introduces the idea of prevailing bias. And now I want to go one step further and introduce the concept of a prevailing bias. In the stock market, participants' biases find expression in buy and sell transactions. Other things being equal, a positive bias leads to high rising prices, and negative bias leads to falling prices. Therefore, the prevailing bias is an observable phenomenon. And also, a typical case is that the self-reinforcing process begins with moderate self-correction at an early age. If the trend persists after correction, the bias has a chance to strengthen and become entrenched. As the process continues, corrective behavior gradually diminishes, while the danger of reversal at the peak increases. This is Soros' basic description of booms, bubbles, and reversals. Bias is not static. It can accumulate in the course of market process and turn into a self-reinforcing trend. When Soros extends this logic to the broader financial system, what he emphasizes above all is credit. He writes, I have proposed not only the general theory, the theory of reflexivity, but also another more specific theory, the theory of the credit and regulatory cycle. The latter consists only of immature ideas, and hardly deserves to be called a theory. Nevertheless, I've tried to use it to interpret the historical process of our own time and make predictions, and in doing so I have offered empirical evidence of fundamental difference between explanation and prediction under reflexive conditions. In addition, I've tried to draw several general conclusions from the analysis. First, credit, not money, is crucial. In other words, monetarism is a false conceptual framework. Second, the concept of general equilibrium has nothing to do with the real world. The nature of financial markets is instability. This leads to a third question. What policy tools are required to restore the stability of the economic system? In this part of the book, there's also a remarkably sharp analysis. In the early age of the reflexive process of credit expansion, the amount of credit involved is relatively small, and its effect on the valuation of collateral can be ignored. That is why the process seems so healthy at the beginning. But as total indebtedness accumulates, The weight of credit becomes increasingly important and begins to have an enhancing effect on collateral values. The process continues until the increase in total credit can no longer stimulate the economy. At that point, collateral values have become excessively dependent on the stimulus of new lending. And when new lending fails to accelerate, collateral values begin to decline. The erosion of collateral values depresses the economic activity, which in turn intensifies the erosion of collateral values. By then, collateral is already fully utilized, and even a slight decline can trigger margin calls and loan liquidation, further deepening the downturn. This is the anatomy of a typical boom-bust cycle, and his immediate judgment is, it is strange that the reflexive connection between loans and collateral values has still not been widely recognized. The literature on this business cycle is immense, yet the reflexive relationship is largely ignored. This shows that, in Soros' view, instability in the financial system is not accidental noise. It is endogenous to the feedback process between the credit and asset prices. At the same time, it also sees regulation itself as part of the reflexive process. Economic history is punctuated by booms and busts. The relationship between regulators and the economy, the regulator itself, is reflexive. Swing from one extreme to another, and in that sense, it too exhibits cyclical characteristics. What is the relation between the regulatory cycle and the credit cycle? On this question, my views are very tentative, but I believe that the two cycles roughly overlap. The lower limit of regulation tends to correspond to the upper limit of credit expansion, and vice versa. At the same time, Soros also clearly warns that reflexivity should not be extended without limit. He says in the Alchemy of Finance, I describe reflexivity as a theory of universal validity. In one sense, that was correct, because the two-way feedback mechanism at the heart of reflexivity can operate at any time. But in another sense, it was mistaken, because it does not operate at all times. In fact, in most cases, it is so weak that it can safely be ignored. We can distinguish between near equilibrium and far from equilibrium conditions. In the former, some corrective mechanism prevents perception and reality from diverging too far. In the latter, the double feedback mechanism of reflexivity is at work, and unless existing conditions or institutions undergo significant change, perception and reality will not converge. It continues. In the first case, classic economic theory is applicable, actually, and the divergence between perception and reality may be treated as noise and ignored. In the second case, equilibrium theory becomes irrelevant. What we face is a one-way historical process in which changes in perception and reality are irreversible. We must distinguish between these two states because one is normal and the other is abnormal. And he adds, even more cautiously, but overextending the concept of reflexivity can also be dangerous, and I've paid the price for it myself. Financial markets can go through long dormant periods in which they show no reflexive reign and behave more like the random walk postulated by efficient market theory. In such situations, apart from exploring reflexive hypotheses, the best thing to do may be nothing at all. Treating reflexivity as an intermittent phenomenon rather than a universally effective condition opens up a broad field of inquiry. It immediately poses a question: how do we distinguish near equilibrium from far from equilibrium conditions? So the alchemy of finance is not simply telling us that the markets are always distorted or the markets are always in a reflexive blow-up at every moment. It is telling us something more subtle. Sometimes financial markets are near equilibrium, and sometimes they are far from it. Sometimes deviations are merely noise, and sometimes they become historical forces. Finally, Soros brings everything back to the financial markets themselves. He says, in financial markets, distortion becomes especially pronounced. The participants' bias is one of the factors that determine prices. Every important market move is affected by participants' bias. The search for an equilibrium price is therefore bound to be futile. And also, the role of reflexivity in financial markets means that changes in financial markets must be interpreted as a historical process. If I had to summarize the alchemy of finance more precisely, I would say that what it truly overturns is not merely the superstition that the market is always right. Its deeper challenge is this. In financial markets, there is no pre-existing equilibrium price waiting to be discovered. Once participants' perceptions affect the situations in which they participate, price is no longer a passive approach toward a given truth. Price itself enters reality through bias, expectations, credit, collateral values, and corporate behavior, and changes reality, eventually. Accordingly, price formation is not a process of discovering a true value, but a historical process of unfolding, feedback, and emergence. This is why for Soros, the market should not be understood as a system that searches for an equilibrium point, but as a process in which perception and reality map onto one another and mutually shape each other. That is the most fundamental meaning of reflexivity. Thank you for watching this video. If you like this video and if you enjoy this channel so far, please like this video and subscribe our channel. We will see each other in the next video.